Imagine you found your perfect new home, and you're ready to make an offer. Then, this stack of papers lands in front of you. Thick, dense, full of legal speak.
Yeah.
It can feel like you need a law degree just to understand it, right?
Absolutely. Overwhelming.
Today, we're cutting through that complexity. Our deep dive is into one of the most critical documents in buying a home in Wisconsin. The WB11 Residential Offer to Purchase.
Mm-hmm.
This isn't just paperwork. It's a detailed legal contract that sets the terms for, well, probably your biggest investment. And it's designed to protect both you, the buyer, and the seller.
And our mission, really, is to transform this seemingly intimidating document into a clear roadmap.
Yeah.
We'll pull out the absolute most important nuggets of knowledge, helping you understand not just what the contract says, but why it matters, what's really at stake.
And maybe find those crucial, unexpected protections hidden in the detail.
Exactly. Those little things that can make a big difference.
Think of this as your shortcut to confidently navigate the home buying process. We're going to cover everything from what's physically included in your purchase,
Right, the nitty-gritty.
to the intricate dance of deadlines and dollars, and some surprising legal safety nets you might not even know you have.
Right.
So let's jump in.
Let's do it.
So we're looking at the WB11 form itself.
Mhm.
It kicks off by establishing the basics, who's making the offer, the date,
Standard stuff.
and identifies you, the buyer, and the property by its address in Wisconsin. Pretty straightforward, but it sets the stage for everything that follows.
And what's immediately striking is how much emphasis the document places on clarity right from the very first line. While the purchase price is the big number everyone focuses on, the form quickly moves to explicitly define what that price actually includes.
This is where it gets really interesting, because the form makes it crystal clear. The purchase price covers the property, all fixtures on the property, as of the date stated on line 1,
Right.
unless something is specifically excluded.
Right.
And there's a really important note in the form itself that says, and I'm quoting here, the terms of this offer, not the listing contract or marketing materials, determine what items are included or not included. That's huge, isn't it? What does that mean for you?
It means what you think is included from maybe the listing photos or the marketing. Well, it might not be, unless it's a fixture or explicitly written into the offer itself. So this raises a crucial question. What exactly is a fixture?
Okay, yeah, kind that.
The WB11 defines it as an item of property which is physically attached to or so closely associated with land, buildings, or improvements so as to be treated as part of the real estate.
So in plain English, if you need a tool to remove it, or if taking it would leave a hole.
That's a pretty good rule of thumb, yeah. It's probably a fixture then.
That makes sense. And the list of examples in the form could be quite surprising.
It's pretty comprehensive.
For instance, it covers things you might expect, like central heating and cooling units, ceiling fans, built-in appliances. Okay.
Sure, the obvious stuff.
But it also explicitly includes garden bulbs, plants, shrubs, and trees.
Which can sometimes be a point of contention, believe it or not.
I can imagine. And get this, audiovisual wall-mounting brackets are fixtures.
But not the TV itself.
But not the actual TV or speakers.
That's
Exactly.
fair.
Or in-ground pet containment systems. Yeah. The whole system, receiver and all.
Right.
So if the seller takes their favorite rose bush or their custom PV mount, it could be a dispute unless you've specifically excluded it, or I guess included it, if it wasn't a fixture.
Precisely. This meticulous detail aims to prevent those common arguments after closing.
Okay.
The form even has a caution prompting sellers to identify anything that looks like a fixture but isn't included, or maybe it's rented, like a water softener or an LP tank.
Oh, good point.
And that not included in purchase price section is your space as the buyer or seller to make sure everyone agrees on, say, the seller's price chandelier. Does it stay or go? Write it down.
Okay, so once you know what you're actually buying, the next crucial step is understanding how your offer becomes, binding, how the contract gets locked in, and the money that backs it all up.
Yep.
Getting an offer accepted isn't just about the seller signing on the dotted line, is it?
That's right. That's not the whole story. The concept of binding acceptance is key here.
Okay.
The offer only becomes truly binding if a copy of the accepted offer is actually delivered back to you, the buyer, by a specific date.
Delivered. So physically in hand or electronically received.
Exactly. This means if the seller signs it, but you don't receive that accepted copy back by the deadline, maybe the agent is slow or there's a delay, the contract isn't binding.
Wow. And there's a real kicker here.
Yeah.
The offer can be withdrawn by you, before that accepted copy is delivered.
That's huge.
So until that document is physically or digitally in your hands, the deal isn't fully sealed. It's a bit like a game of tag, isn't it?
It truly is. High-stakes tag.
Yeah.
This brings us to another critical concept. Time is of the essence.
Right, I see that phrase a lot.
The WB11 explicitly applies this to several key items. Earnest money payments, binding acceptance, the occupancy date, the closing date, and very importantly, contingency deadlines.
So what does time is of the essence actually mean in practice?
It means if that phrase applies to a date, missing that exact date or deadline is a breach of contract. Period. No wiggle room.
No reasonable time excuses.
Not if time is of the essence applies. If it doesn't apply, then yeah, performance within a reasonable time is generally allowed. But for those specific items, you hit the date or you're potentially in default. It's very strict.
So what does this all mean for your earnest money? This is, the significant chunk of money you put down to show you're serious.
Your skin in the game.
Exactly. The form gives you options for how to deliver it. With the offer or mailed, delivered commercially, electronically, within a certain number of days after acceptance. Usually 5 days if you leave it blank.
And this often raises an important question for buyers. What happens to that earnest money if the deal ultimately falls through?
Yeah, that's a big concern.
The document is actually quite detailed here, especially if a real estate firm is holding the money. If negotiations just fizzle out, no accepted offer, it's promptly returned to you.
Okay, simple enough.
If the deal closes, great. It's applied toward your purchase price on the closing statement.
Makes sense.
But if the offer doesn't close after being accepted, the earnest money is only dispersed according to a written disbursement agreement signed by all parties to this offer.
Ah, so everyone has to agree in writing where that money goes if the deal collapses.
That's the rule.
Yeah.
Both buyer and seller have to sign off.
That's a crucial distinction. What if you can't agree on that disbursement? Maybe both sides think they're entitled to it.
That happens. If that written agreement isn't reached within 60 days of the planned closing date, the firm holding the money has specific legal pathways. They can't just decide themselves.
What kind of pathways?
It could involve getting direction from an independent attorney, depositing the funds with a court hearing a lawsuit, following a court order, or some other legal authorization. They can even deduct some minor legal fees, up to $250 from the earnest money to sort it out.
Wow. So it can get complicated.
It can. But here's the most important takeaway for you as a buyer or seller. The firm's disbursement of earnest money does not determine your ultimate legal rights to that money.
Meaning,
Just because the firm gives the money to one party, based on, say, legal advice, doesn't mean the other party can't still sue. The form explicitly states that small claims court in Wisconsin has jurisdiction over all earnest money disputes in residential sales.
so that's where you'd fight it out legally.
That's the venue. And the document strongly advises consulting an attorney if a dispute arises. Understanding this protects your money and tells you where to go if things get stuck.
Okay, let's shift gears to contingencies. Think of these as your built-in safety nets, right? They let you walk away from the deal without losing your earnest money if certain conditions aren't met.
Exactly. Your escape hatches, legally speaking. The WB11 spells out several common ones and how they work. Generally, you can only conduct inspections or tests if you've specifically included contingencies for them in your offer.
You can't just decide later you want to test the well water.
Not unless you added a testing contingency. The form is careful here. It defines an inspection as basically an observation.
Looking around.
Right. It doesn't include appraisals or testing, except for testing for leaking carbon monoxide, LP gas, or natural gas. Those specific safety tests are authorized under a general inspection.
Okay.
A test, on the other hand, is specifically defined as the taking of samples for laboratory or other analysis. So taking soil samples, water samples, mold samples that requires a specific testing contingency.
Got it. And you, the buyer, you're usually responsible for the costs of these inspections and tests, right?
Correct. And you also agreed to put the property back the way you found it afterwards, promptly restore it.
Makes sense.
Plus, you have to promptly provide copies of all inspection and testing reports to the seller, both good news and bad news. Transparency is required.
Okay, so let's talk about the big one, the inspection contingency.
probably the most common one. This makes your offer contingent upon a licensed Wisconsin home inspector doing an inspection that doesn't disclose any defects.
Okay, another definition needed. What's a defect in this context?
The form defines it pretty clearly. It's a condition that would have a significant adverse effect on the value of the property.
So lowers the price significantly.
That would significantly impair the health or safety of future occupants.
Like mold or bad wiring.
Or that, if not repaired, removed, or replaced, would significantly shorten or adversely affect the expected normal life of the premises.
Like a failing roof or foundation issues.
Exactly. It's got to be something serious. Significant adverse effect, significant impairment, significantly shortened life, not just minor cosmetic stuff.
So this contingency is satisfied, meaning you move forward, unless you deliver two things within the time frame, right?
Yeah.
Often 15 days.
Correct. You need to deliver a copy of the written inspection report itself.
The whole report.
And a separate written notice of defects. This notice specifically lists the defects you object to. Just proposing an amendment, asking the seller to fix things isn't enough. You need that formal notice of defects.
Okay, crucial detail. And then what happens? The seller's right to cure comes into play.
Usually, yes. The default setting in the form is that the seller shall have the right to cure the defects you listed in your notice.
So they get a chance to fix things.
Right. If they elect to cure, they have to give you written notice saying so, usually within 10 days. Then they have to fix the defects in a good and workmanlike manner and give you a written report detailing the work they did no later than 3 days before closing.
What if they don't have the right to cure? Maybe you negotiated that out. Or what if they just choose not to fix the problems or miss their deadline to respond?
In any of those cases, seller doesn't have the right, elects not to cure, or fails to respond in time, then the offer becomes null and void.
And you get your earnest money back and walk away.
Exactly. It's a critical fork in the road for the deal.
Okay. Similarly, there's often a radon testing contingency.
Yes, very common now. Makes the offer contingent on a qualified third-party radon test showing an EPA average radon level of less than 4.0 picocuries per liter, which is the EPA's action level.
And does the seller usually have a right to cure that too?
Typically, yes. They can cure by installing a radon mitigation system, usually a pipe and fan system, and then they have to provide a post-remediation test report showing the levels are now below 4.0 PCIL.
All right, moving to money stuff. The financing commitment contingency. This is a big one for most buyers.
Absolutely essential if you need a mortgage. This makes your offer dependent on you being able to get a specific mortgage loan commitment.
And you have to detail the loan type, the amount, the term, maximum interest rate, monthly payment.
Yes, you fill in those blanks to define the loan you need. If you can't get a commitment for a loan meeting those terms, you're protected by the contingency.
So how is this contingency satisfied? When is it officially met?
It's satisfied if, after your review, you deliver to the seller a copy of a written loan commitment that is either signed by you or accompanied by your written direction for delivery.
So you have to actively deliver it, not just the lender sending it over.
Correct. The form states, delivery of a loan commitment by buyer's lender or delivery accompanied by a notice of unacceptability shall not satisfy this contingency. You, the buyer, have to make the affirmative step of delivering it as acceptable.
And the document adds a pretty powerful caution here, doesn't it? About risk shifting.
It does. It says, buyer understands delivery of a loan commitment, removes the financing commitment contingency from the offer, and shifts the risk to buyer if the loan is not funded.
Okay, break that down. What does that truly mean for someone buying a house?
It's a huge shift in risk. Once you deliver that commitment letter, you're essentially telling the seller, I've got my financing lined up, we're good to go on the money front. If, for some reason, the loan falls through after that point, maybe you lost your job suddenly, maybe you went out and bought a car and messed up your debt-to-income ratio, maybe the lender just changes their mind for some underwriting reason.
Oh, wow.
You, the buyer, are now on the hook because you removed the financing contingency. You could be found in default of the contract and risk losing your earnest money and potentially even be sued for more.
So the delivery of the commitment is a really significant moment.
It's critical. You need to be absolutely sure that loan is solid before you remove that safety net.
And the seller also gets termination rights if you don't deliver that loan commitment by the deadline you agreed on.
Yes. If the deadline passes and they haven't received the commitment from you, they can terminate the offer.
And interestingly, if you can't get financing, the seller even has the option to offer to finance it themselves.
Yeah, it's in there. They can offer to become your lender under the same terms you were seeking. Doesn't happen often, but it's an option.
Another vital safeguard, the appraisal contingency.
Yes, protects you from overpaying based on the agreed price. This makes the offer dependent on the property appraising for a value equal to or greater than the agreed upon purchase price.
So if you offer $300,000, it has to appraise for at least $300,000. What if it comes in lower, say $290,000?
Then you, the buyer, can deliver a copy of the appraisal report and a written notice objecting to the low appraisal.
And then what? Does the seller get a chance to fix it? Like the right to cure?
Usually, yes. The seller typically has a right to cure by delivering a written notice that they agree to adjust the purchase price down to the appraised value, in your example, $290,000.
So they can save the deal by lowering the price. If they don't.
If they don't have the right to cure or choose not to, the offer becomes null and void.
Okay. And finally, let's touch on a situation that can put a lot of pressure on buyers. The closing of buyer's property contingency, when you need to sell your current house to buy the new one.
Right, a very common scenario. Your offer is contingent on your sale closing, but this often comes with something called the bump clause.
The bump clause. Sound ominous.
It can feel that way. It basically allows the seller, even though they've accepted your contingent offer, to keep marketing their property. If they receive another acceptable offer, a secondary offer, they can give you, the primary buyer, written notice, the bump notice.
Okay, so they bump you.
They give you notice that you might get bumped. You then have a limited time. The default is 72 hours, but it can be negotiated to react.
React how?
You have to waive two things. Your own property sale contingency, meaning you're now obligated to buy whether your house sells or not. And D, you usually have to provide proof of funds or evidence of a bridge loan showing you can actually close without your sale proceeds.
Wow, that's a huge decision in just 72 hours.
It is high pressure. If you don't provide that waiver and proof within the bump clause time frame,
Then
your offer becomes null and void and the seller is free to move forward with the secondary offer. You're out.
So if we zoom out from all these contingencies, inspection, radon, financing, appraisal, buyer's property, these aren't just like legal clauses buried in the text.
Not at all. They're your practical tools, your levers to manage risk in what's likely the biggest financial decision of your life. Understanding them, negotiating them carefully, it's absolutely paramount to a smooth and safe transaction.
Okay, beyond the core deal itself, there are these crucial disclosures and responsibilities that really shape what you're buying and what your future ownership might look like.
Definitely. What you need to know about the property's history and condition.
In Wisconsin, the Real Estate Condition Report, or RECR, is a cornerstone of this, right?
It absolutely is. Wisconsin law requires most sellers of properties with 1 to 4 dwelling units, so houses, duplexes, up to fourplexes, to provide prospective buyers with a completed RECR.
And there's a deadline for that.
Yes. Typically, they have to give it to you no later than 10 days after your offer is accepted. There are some exceptions, like for properties never inhabited, brand new construction, or sales by certain court-appointed fiduciaries, like an estate sale sometimes.
And this report is much more than just a formality, isn't it? It has real teeth for the buyer.
It does. The law gives you, the buyer, certain rescission rights tied to this report.
Like what?
For example, if you don't receive the report within that 10-day period after acceptance, you have a window, 2 business days after that 10-day period expires, where you can just rescind the entire contract, no questions asked.
Wow, okay.
You might also have rescission rights if a report disclosing defects you weren't previously aware of is furnished after your offer is submitted but before those 10 days are up. You get a couple of days to review and potentially back out based on that new information.
So it's a powerful tool for uncovering issues. And this report ties directly into another section, the property condition representations.
Exactly. In that section, the seller states, essentially, that they have no notice or knowledge of conditions affecting the property or transaction other than whatever they've already identified in their real estate condition report.
And that phrase, conditions affecting the property or transaction, how broad is that definition?
Oh, it's incredibly broad. It covers almost anything you can imagine that might negatively impact the property or the deal itself.
It's fascinating how much ground this covers. Just to give folks a sense of the detail, it includes obvious things like defects in the roof, basement foundation, electrical, plumbing.
Sure, the structural and mechanical stuff.
Water heaters, pools, leaks, defects in heating ACs, wood-burning stoves, problems with smoke or carbon monoxide detectors, issues with any fixtures included. Okay. Expected.
I think it goes much further.
Right. Environmental concerns like unsafe concentrations of radon, radium in water, lead in paint or soil or water, mold, asbestos, or other hazardous substances. It even specifically mentions the manufacture of methamphetamine on the property.
Things you absolutely need to know for health and safety and value.
It covers defects related to joint wells or septic systems, underground or above-ground fuel storage tanks, potential contamination risks there.
Big potential costs.
Notices of property tax increases, pending reassessments or special assessments coming down the pike, proposed public construction nearby, unpermitted additions or remodeling or illegal land divisions.
Zoning and compliance issues.
If the property is part of an HOA or is in a floodplain, wetland, or shoreland zoning area, all things that restrict use.
Right, or non-conforming uses, conservation easements, or if someone else has rights to use part of the property, like a shared driveway.
Even if the property has been assessed as agricultural land, which can impact taxes. If there's a dam located on the property, or if you'd be getting an ownership interest in a dam offsite.
Water rights and dam safety are complex issues.
Lack of legal access, maybe your driveway crosses someone else's land without a proper easement. Boundary or lot of line disputes.
Headaches waiting to happen.
Regulations requiring repairs or alterations. Any insurance claims relating to damage in the last 5 years. Peers not complying with regulations. Past or current termite, powder post beetle, or carpenter ant infestations or other critter infestations.
Bugs and pests, definitely a condition.
If the structure is designated as historic, if there are burial sites on the property, agreements binding subsequent owners like leases or odd things like credit extensions from electric cooperatives.
Things that carry over to you.
And finally, a catch-all for other defects like drainage problems, grading issues, or excessive sliding or settling.
It's an exhaustive list, and it really underscores the critical importance of your due diligence as a buyer. It's not just about what you can see during a walkthrough.
Yeah.
It's about understanding the deep legal, environmental, and structural history that can impact a property's value and your future as an owner. These are the kinds of issues that can turn a dream home into a financial nightmare if they're not uncovered early.
Absolutely. Okay, so as you get closer to the finish line, to closing, the document also addresses closing prorations. What does that mean?
It means that certain ongoing expenses associated with the property are split fairly between the buyer and the seller based on the closing date.
Like property taxes.
Exactly. Real estate taxes are the big one. Also, things like rents, if it's an investment property, maybe condo or HOA assessments, municipal charges, fuel.
So if the seller already paid the property taxes for the whole year, but you close on July 1st, you'd essentially reimburse the seller for the half of the year that you'll own the house.
Precisely. You pay your share, they pay theirs. It's prorated, usually based on the last known tax bill amount.
But taxes can change, right? Especially with new construction or big remodels.
Good point. The document anticipates that. It notes that the actual real estate taxes for the year of closing and subsequent years may be substantially different than the amount used for proration.
Okay.
Especially in transactions involving new construction, extensive rehabilitation, remodeling, or area-wide reassessment.
So what happens then?
You and the seller agree in the offer to reprorate the real estate taxes once the actual tax bill for the year of closing becomes available. This is a post-closing obligation just between the two parties.
So you might owe the seller more money, or they might owe you months after closing.
Could be. And importantly, this reproration is not the responsibility of the real estate firms or the title company. It's up to you and the seller to handle it directly later on.
Good to know. Then there's title evidence. What's the seller obligated to provide here?
Upon payment of the purchase price at closing, the seller is obligated to convey the property to you by warranty deed that's the strongest type of deed, free and clear of all liens and encumbrances.
Meaning no mortgages, judgments, unexpected easements.
Right, except for certain things that are usually listed as permitted exceptions, like municipal ordinances, recorded utility easements that serve the property, recorded building restrictions, and importantly, the current year's taxes, which get prorated.
And how do they prove the title is clear?
The seller provides evidence of title, usually in the form of an owner's policy of title insurance.
Okay, title insurance. Who pays for what there?
Typically, the seller pays for providing this owner's title policy to you, the buyer. You, the buyer, usually pay for any separate title policy your lender requires, the lender's policy, and for the cost of recording the deed and the mortgage at the county register of deeds.
And there's something called a gap endorsement?
Yes. By default, the seller pays for this. It's an endorsement to the title policy that covers the gap in time between the date the title commitment was issued and the moment your deed is actually recorded. It protects against any new liens or encumbrances popping up unexpectedly during that short window. It's a subtle but important protection.
Okay, what happens if the property gets damaged between the time your offer is accepted and the closing date? Like, say, a tree falls on the roof during a storm.
That's covered too. If the damage is relatively minor specifically, not more than 5% of the purchase price, the seller has to notify you, and they are obligated to repair the damage and restore the property before closing.
Though they fix it and the deal proceeds.
Usually, yes. But if the damage exceeds 5% of the purchase price, so significant damage.
Like a fire or major storm damage.
Right. The seller still has to notify you promptly, but then you, the buyer, get a choice. You have the option to terminate the offer and walk away.
Okay.
Or, if you still want the property despite the significant damage, you can choose to proceed with the closing. If you do that, you'd be entitled to any insurance proceeds the seller receives, or is entitled to receive, related to that damage. Plus, you'd get a credit at closing for the amount of the seller's insurance deductible.
So you'd essentially take the insurance money and handle the repairs yourself after closing.
Exactly. You take on the damaged property plus the funds to fix it.
This is exactly why your buyer's pre-closing walkthrough is so vital, isn't it?
Absolutely critical. The document specifically grants you the right within 3 days prior to closing to walk through the property one last time.
And what are you looking for?
2 main things. First, to confirm there's been no significant change in the property's conditions since you made the offer, no new damage like we just discussed. Second, to verify that any repairs the seller agreed to make, maybe based on the inspection contingency, have actually been completed in a satisfactory way.
It's your final check before signing the closing papers and handing over the money.
Exactly. Don't skip it. It's your last chance to catch problems before the property is officially yours.
Okay, finally, let's talk about what happens if things just plain go wrong, defaults, and some absolutely critical legal warnings buried in the fine print that maybe people gloss over.
Yeah, the what-if scenarios and the big flashing warnings.
The WB11 explicitly states that seller and buyer each have the legal duty to use good faith and due diligence in completing the terms and conditions of this offer.
That's the baseline expectation. Act honestly and make reasonable efforts.
A material failure to perform any obligation under the offer is a default. And defaulting can lead to liability for damages or other legal remedies.
Right. Breach of contract has consequences.
So, if you, the buyer, default, maybe you just get cold feet and decide you don't want the house anymore without a valid contingency reason.
Right.
What can the seller do?
The seller has options laid out in the form. Option 1. They can sue you for specific performance.
Meaning force you to buy the house?
Try to force the court to make you complete the purchase as agreed. And they can request the earnest money be applied as partial payment towards the price if they win. That's often difficult to enforce, but it's an option.
Okay, option 2.
Option 2, they can terminate the offer. And then they have another choice. Either keep the earnest money you deposited as liquidated damages.
Meaning that's the agreed-upon penalty, end of story.
Usually, yes. If they choose liquidated damages, they generally can't sue you for more, even if their actual costs were higher. Or, instead of keeping the earnest money, they can choose to sue you for their actual damages. Maybe the market dropped and they had to resell for less, plus carrying costs. They could sue you for that difference.
So they have choices if the buyer flakes. What if the seller defaults? Maybe they get a better offer and refuse to close with you.
You, the buyer, have similar remedies available. You can sue the seller for specific performance, try to force them to sell you the house as agreed.
Yeah.
Or you can terminate the offer and demand the return of your earnest money. And importantly, even if you get your earnest money back, you can also sue the seller for your actual damages. Maybe you incurred costs for inspections, appraisals, moving arrangements. You could sue to recover those. Or you could potentially sue for the loss of the bargain if the property value went up.
So both sides have legal recourse if the other party breaches the contract.
Absolutely. It's a binding agreement.
And there's that really crucial note, often in bold text near the end of the form. It basically screams, if accepted, this offer can create a legally enforceable contract.
Hard to miss.
Both parties should read this document carefully. The firm and its agents may provide a general explanation, but are prohibited by law from giving advice or opinions concerning your legal rights under this offer or how title should be taken at closing.
A very important disclaimer for the agents.
An attorney should be consulted if legal advice is needed. That's a very clear directive, isn't it? It underscores the seriousness of this whole document.
It truly does. It highlights that a real estate transaction isn't just about finding a house you like and agreeing on a price. It's a deeply complex legal agreement with significant, long-lasting implications.
Yeah.
Critical thinking, reading carefully, and seeking professional legal advice when you need it are your absolute best defenses against unforeseen pitfalls and potentially very expensive mistakes. Don't rely solely on your agent for legal interpretation.
Good advice. Now, another surprising detail that many people might not be aware of is tucked away in the Foreign Investment in Real Property Tax Act section for PDA.
Ah, yes, for FIRPTA. An IRS requirement.
This explains that if the seller is a foreign person, and that's defined broadly as like a non-resident alien individual, a foreign corporation, partnership, trust, or estate,
Basically not a U.S. resident or entity for tax purposes.
then you, the buyer, might be required by the IRS to withhold a tax. It can be up to 15% of the total amount realized in the sale.
15%. That's a huge chunk of the sales price.
What does amount realized generally mean in this context? Just the sales price.
In simple terms, yes. Amount realized is usually the total sales price, the gross amount before deductions.
And the caution notice here is pretty stark, isn't it?
It is. It says, under this law, if seller is a foreign person and buyer does not pay or withhold the tax amount, buyer may be held directly liable by the U.S. Internal Revenue Service for the unpaid tax, and a tax lien may be placed upon the property.
So if the seller's foreign and you don't withhold that 15%, the IRS could come after you, the buyer, for that tax
Okay.
and put a lien on your new house.
That's exactly the risk. It's a direct liability for the buyer if the withholding isn't done correctly when required.
Wow. That's incredibly important. Who figures this out? The agents, the title company.
No, and that's key. The form explicitly states that real estate firms, agents, and title companies are not responsible for determining the seller's FIRPTA status or figuring out if an exemption might apply.
So it's on the buyer and seller.
Yes. It advises parties to consult their own legal and tax advisors about FIRPTA. Usually the seller provides a certification of non-foreign status, but if they can't, or if you have reason to doubt it, you absolutely need expert advice to handle the withholding properly. This is a very real, very high-stakes risk for a buyer to be aware of. Don't ignore the FIRPTA section.
Definitely not. Okay, finally, one of the most critical warnings in the entire document, often found right near the very end, maybe even on the last page, the wire fraud warning.
Oh, this one is so important in today's world, absolutely crucial.
It stresses, wire fraud is a real and serious risk. Never trust wiring instructions sent via email. Funds wired to a fraudulent account are often impossible to recover.
And they mean impossible. Once that money is gone, it's usually gone for good.
It strongly advises, and this is direct advice in the contract, do not initiate any wire transfer until you confirm wiring instructions in person or by you calling a verified number of the entity involved.
Not the number in the suspicious email.
Right. Never use contact information provided by any suspicious communication. Again, it clarifies that real estate agents and firms are not responsible for the transmission, forwarding, or verification of any wiring or money transfer instructions.
This is not just legal boilerplate to cover the agents. It's a direct, practical warning based on widespread, devastating losses people have suffered.
You hear horror stories.
All the time. Scammers are incredibly sophisticated. They can hack email accounts, make messages look exactly like they came from your agent or the title company, with wiring instructions that are just one digit off, sending your life savings to a criminal.
So the advice is paramount. Always verify wiring instructions through multiple trusted channels.
Yes. Ideally, confirm them in person at the title company, or at the very least by calling a phone number for the title company that you independently verified, maybe from their official website that you typed in yourself, or a number you got early in the process. Never, ever rely solely on instructions sent via email.
This one piece of advice could literally save you hundreds of thousands of dollars, your entire down payment.
Easily. It's perhaps the most immediate, practical risk to manage right at the end of the process. Be paranoid about wire instructions. Verify, verify, verify.
So after digging through all of this, what does it all mean for you, the listener? We've navigated this really intricate landscape of a Wisconsin residential offer to purchase.
Yeah, we covered a lot of ground.
And we've uncovered how incredibly detailed these forms actually are, from what's considered a fixture in your new home.
Yeah.
Yes, even those garden bulbs we talked about.
Right down to the plants.
To the meticulous, sometimes complex dance of earnest money disbursement if a deal goes sideways. and all those crucial protections built into the contingencies. This document truly tries to cover every single base.
It really does. From defining those seemingly minor fixtures to understanding why time is of the essence matters so much for certain deadlines, and the surprisingly complicated rules around earnest money if a deal falls apart. Every line serves a purpose.
Yeah.
It really underscores that understanding these legal instruments, this contract, isn't just about avoiding problems, although that's part of it. It's really about empowering yourself.
How so?
By knowing your rights, knowing your obligations, knowing your safety nets, you're in a much stronger position in what will likely be one of your most significant financial transactions ever. Knowledge is power here.
It truly hammers home the point that these aren't just forms to quickly skim through and sign, hoping for the best.
Definitely not. They are comprehensive legal contracts designed over years of experience to protect both buyers and sellers by anticipating almost every potential snag you could imagine might happen during a real estate deal.
So read carefully, ask questions, and get advice when you need it.
That's the takeaway. Be an informed participant. And that leads us to maybe a final thought for you, the listener.
Yeah?
As you consider your next big purchase, whether it's property or really anything else that involves signing a formal contract, maybe a car, maybe a major service agreement, think about the hidden clauses and the specific definitions like fixture or defect that we discussed today. How might a deeper dive into any standard agreement reveal unexpected protections or maybe hidden liabilities you hadn't considered before? The power, so often, is truly hiding in the details of the fine print.